We're going to look at Chapter 18, Financial Modeling and Pro Forma Analysis. Um, as a financial manager, as a business manager, one of the things that financial management requires of you is to be able to forecast your financing needs down the road. If you expand, if sales increase, if costs increase, how would you bring in the new capital to meet that growth? So to answer that question, we have to first forecast our growths, and then using certain methodology, be able to estimate how much financing we would need. So when we are talking about financial planning, we have to understand that our goal over here is to understand and identify the important linkages between sales, cost, capital investment, financing. Because these numbers, sales, costs, and thus from there, capital investment and financing, they don't operate in a vacuum. They are connected to each other. How we estimate sales will project into what kind of cost structure we will have, and then we can determine, do we have enough capital to finance any growth that we see here. Growth is good, but growth without proper planning to meet the opportunity that growth presents would make growth meaningless. So growth in and of itself does not do anything for a firm unless there are plans, capital investments, and financing that takes advantage of those growth potentials. So based on that, once we have created a framework to analyze these linkages, then we have to figure out the impact on our business plans in the future. And thus we have to plan for our funding in the future. So that's kind of the main goal of long-term financial planning, so that when growth happens, we are ready with the resources to meet the challenges that growth presents. So one of the things that we assume, and this is an assumption, that balance sheet items and income statement items grow, and this is the key part, proportionately with sales. It's an assumption, but it's a reasonably defensible assumption that the ultimate goal of a business is to increase value. And one of the ways you increase value is by driving sales. You have to sell more of the product that you're making. But when you sell more of the product you're making, that has a contagion effect on the rest of the firm. As you increase sales, you may need more sales agents to drive that sales. So that's a cost. As you increase sale, you would need more inventory to produce the product. Well, that's a cost. You may need to buy new equipment or new land or new buildings. That's a cost. And thus, the items that are part of the balance sheet and that are part of the income statement have a level of proportionality with sales. So when sales increase, these costs and investments will increase, and thus we have to figure out how to address those increase in costs and investments. So this method we call the percent of sales method, and we make another assumption that this percent of sales method is constant in future periods. So once we come up with a percentage for our baseline year, which could be the current year, and then we project it into the future for next year and beyond, we have to make some assumptions of keeping those items constant, unless there is a compelling reason for us to change those constant percentages. So here is an income statement and balance sheet for a company that we are going to be looking at in this chapter, KMS. So these are our 2013 numbers. So here is a typical balance sheet. You have sales minus costs. That gives us EBITDA, earnings before interest, taxes, and depreciation and amortization. Then we subtract depreciation, gives us EBIT. Then we subtract interest expenses. That gives us earnings before taxes or pre-tax. We can call this EBT. And then we pay our taxes, and that gives us net income. So what we have done over here, and this is the key column that we have generated, that we have restated all of the items from number 4 through number 11 as a percentage of sales, except things like these, because these are not literally percentage of sales. These are numbers that are based on, for example, interest expense is based on how much debt you have, and income tax is based on how much pre-tax income you have. But the rest of the items, cost, depreciation, and your net income particularly, these are the three main items that we are looking at. They are established as a percentage of sales. So your cost except depreciation is 78%. How do we calculate that? Well, we take 58,413, divide that by 74,889. So this number divided by this number gives us 78%. Similarly, depreciation number divided by sales will give you 7.33%, and so on and so forth. And we repeat that same process for balance sheet items, same percentage of sales. So when we look at cash and equivalents, it is 11,982. That divided by 74,889 will give you 16%, and so on and so forth. Notice over here, these are not applicable. Accounts payable is based on past transactions that you have made. Debt is based on past transactions that you have made about taking on debt. Not accounts payable, sorry. Debt and thus total liabilities. So for these three items, we do not need to convert them into percentage of sales. But the rest of them we can, because we're assuming that those numbers in the future will be dependent upon what sales number we get. So whenever you see NM, it simply means it's not meaningful. We can calculate it. Numerically, we can get a number, but that number does not mean much. So now, for 2014, the company comes up with a forecast. And they say that sales are going to grow at 18%. So now what do? So sales has grown from here to here at 18%. So we take the 2013 numbers, multiply that by 1 plus the growth rate. So this over here is 1 plus the rate of growth. So 1 plus 0.18, so 1.18. Then the rest of the numbers, this number is going to be 78% of this number, 78% of the sales number. So that this then is based on the net between lines 3 and 4. Depreciation is going to be 7.33% of sales again. So we get this. Then EBIT will be the net of EBITDA and depreciation. Interest expense does not change because you have not added any more debt, so your interest expense remains the same. This number changes. It will be the net between EBIT and interest expense. This number will be 35% of the EBT number, or earnings before taxes number. And then finally, that will give us the net over here of net income. So as a result of 18% increase in sales, this is the amount by which net income has increased. What's the implication of that increase in net income? So just as a quick problem over here, if KMS was expecting sales to grow by 10%, what are the costs except depreciation projected to be? So we just went over this. So we take sales number, increase it by 10%, gives us new sales number, and then we use the percent of sales method to forecast the cost of depreciation. So we see that that costs are 78% of sales. So the forecasted sale is this number. So the cost without depreciation would be 78% of the forecasted sale. That's that number. So that's pretty simple and straightforward. Okay, so now that we had created this income statement, and there are again similar problems you can work on. Now we see how does all of that lead us to create our pro forma, meaning our projected balance sheet. So we make assumptions about how equity and debt is impacted by sales. And then what we will do is we will look at the difference between our assets and our liability and equity to determine how much financing we would need to address that growth. So now what do? We take the 2014 sales number. If you recall, 2014 sales number was $88,369. Okay. So 88,369. 16% of that would be our cash equivalents, because we had established that in 2013 cash equivalents was 16% of sales. So now that sales has increased to 88,369, this is our new sales number. We will build the rest of the items over here as a percentage of that new sales number, keeping those percentages constant at 2013 levels. So we can do all of that. So we take the first three line items, that gives us total current asset. This was 66% of sales, that gives us net current assets. Then we also project our accounts payable. Forget about debt for a moment. Then we project our total liabilities. And before I do this, this is what I have to do. Hold on. So before I can project my total liabilities, I have to go over here and do this line item. So this line item is stockholder equity. That stockholder equity is last year's stockholder equity plus 70% of the new earnings. So in 2014, our new net income, this was the new net income we had for 2014. That new net income, 70% of that will be returned back to the firm in the form of stockholder equity. Where did I get that number from? This is from here, from the first balance sheet that we had prepared, where we had looked at this as, so we had stockholder equity of 74,134. And so why are we putting 70%? Because we are so the percentage sales method over here. Let me do this over here again. So we had 88,369 as our sales. So 16% of that would be our cash equivalents. 19% of sales would be our new accounts receivable. 20% of that would be inventory. That gives us current assets. Then 66% of sales would be our plant, property, and equipment, that gives us total asset. So that part is exactly how we drill it down based on percentage of sales. Accounts payable would be 16% of sales. Debt remains the same because we have not added any new debt. That gives us total liability. This one over here is what we were focusing on. Why is it 79,892? That's based on last year's plus 70% of 8226. Why 70% of 8226? It is because we are retaining 70%. So our dividend payout we are assuming that dividend payout is 30%. That means of our net income of 8,226, 30% we paid out as dividends. That means we paid out as cash to the shareholders. The remaining 70% we reinvested back into the company as retained earnings. So that went to increase retained earnings by from 74,134 to 79,892. Now when we add everything up, this comes out to 98,531. Notice something very interesting that is happening over here. In 2013, as would always be the case, assets equals liability plus equity. In 2014, assets and liability and equity, there's a mismatch. And the extent of the mismatch is 8,396. It's the difference between 1,697 minus 98,531. So that means, where will we get this money? We are investing more in our assets than we have capital. Remember our balance sheet model that I had discussed earlier, that all of these items tell us everything that the company owns. And all of these items tell us everything that the company owes. So our ownership has increased, but how do we pay for it? That means we have a shortfall of 8,396, which then is our net new financing. Okay, so that's the new amount of cash that we would have to raise to meet that shortfall. How do we meet that shortfall? So we have a choice. Either we can finance that shortfall through debt, or we can finance it through equity. If debt is chosen, it will change the interest assumption on the pro forma income statement. So, going over here, let's say we choose that this shortfall of 8,396, we will manage it through debt. So this number is not changing. And this number has to be brought in line from 98,531 back to 106,927. So these two numbers would have to match. And the only way we can do that is by taking this financing shortfall of 8,396 and adding it. In this case, we add it over here. We add it to the debt number. Why? Because initially we are assuming that all new financing will be debt financing. So all of that capital that we need of 8,396, we will take on additional debt. Once we add it there, then that balances out our income statement. Balances out our balance sheet. So the process over here, this is the key part, table 18.3 is the key part, is to change these numbers, get our new asset, change that number, that does not change, of course, because debt is not being added yet. Change all of that number, and then over here, determine what the shortfall is. And that establishes what the new net financing is. Once we have that, then we have to make a decision, do we use debt or equity? Initially, we choose debt, and that choice of debt is added over here to reflect this number change so that the asset number is in balance with liability and shareholder equity. So if instead of paying 30% of its earnings as dividends, it decides not to pay any dividends, and it's deciding to retain everything, how will the new financing change? So currently it pays 30% of dividends. That means rather than retaining 5,758, it will retain all of the 8,226. So what will that do? That will increase stockholder equity, and it will reduce net new financing. By how much? The additional retained earnings now would be this, what it had, minus what it used to be. So this was the old retained earning, and this is the new retained earning. So this is the net addition to our stockholder equity. So the old stockholder equity was, there are two ways you can get this number. One is to take the 74,000 number from 2013 and directly add the new retained earnings, or take the projected number that you had for 2014 and increase it by the new addition. The new addition over here. So our total liability and equity will also rise by 2,468 to this new number. So the net shortfall would now be this number, 5,928. So we have the new liability and equity would be 100,999, and 5,928 is the difference between 1,6927. So this number is 1,6927, which was the assets, our total asset minus the new liability and equity, which is 100,999. So that's the new amount of financing. So by retaining more of our cash and not paying out enough in dividends, what we have done, we have reduced the net new financing that we need. So you can work on a similar problem like this over here, just a different numbers, same problem, and be able to calculate the new net financing. So I'm going to stop over here and continue in the next lecture about how to forecast financial statements using the percent of sales method.